Okay, good afternoon, everyone. We might kick off. I know a few more people might join over the next few minutes, but we'll maybe get into it nevertheless. So thank you for joining this afternoon, and thank you to Insurance Ireland for providing myself and Shane and KPMG the opportunity to speak to you this afternoon. I think we have a really exciting topic, an interesting topic to take you through. And there's probably three core parts to our session this afternoon. So I'm going to spend a little bit of time contextualizing the current ESG landscape, and then moving into some of the regulatory developments in the space. And then my colleague Shane will talk a bit about climate for the third part of the session. For those of you who saw the invite, you will have perhaps expected to see Caroline Pope here. Unfortunately, Caroline can't make it today, so Shane and I will do our best to cover the content that Caroline was due to take. And then just in terms of logistics, so that you will notice there's an option to ask questions. That is through the chat function, if you don't mind. So if you can place your questions to the extent you have any through that, and we'll endeavour to get through as many of them as we can, and to the extent we can't, we can always address them subsequently. So I might just, sorry, before I go into it as well, just very briefly introduce myself and Shane. So I am a director, I'm Connor speaking, and I'm a director in our ESG asset management department. And my colleague Shane, who's a director in corporate finance and also part of our sustainable futures team, are two people who are going to take you through the session today. So maybe before we kick off into the full extent of the session, really, just some context as to sustainable finance and why we're talking about it. And I suppose really the catalyst for a push towards change and everything change towards sustainable finance emanated from the fallout of the financial crisis. Well, I suppose the last financial crisis and not necessarily the one we're currently going through, where there was a perception that financial markets were short-termist, they lacked transparency, and really devoid of any sustainability metrics. And then in tandem with that, in the last few years, and particularly the last maybe 18 months, 24 months, we've had really a profound and quite significant societal shift in expectations on everything from climate change management to how companies interact with stakeholders and not necessarily just shareholders. And actually, it's really been through that lens that the EU began to sharpen their focus and their policy framework around sustainable finance. And we'll come on to that in a few minutes. And what do we mean when we talk about sustainable finance? Because I'm sure a number of you on the call can acknowledge or relate to there being a lot of interchangeable terms in this space. So I think this slide illustrates quite well, and I know that it's quite busy, but good nonetheless at really capturing that sustainable finance is anything that takes account of environmental, social, or governance factors when making investment decisions. And on this slide here, we try to give a little bit more context as to the E, S, and the G. So I think people can relate to E very well. You know, environmental areas, so they're tangible issues that we understand, you know, being climate change, carbon emissions, pollution. Moreover, they're areas or they're facets that we can measure with relative ease and transparency as well. And I think similarly enough, governance. Again, an area that we're quite familiar with and quite comfortable, particularly in the industry people on this call will be on. It has really been the social aspect of the three that has been a bit more abstract, particularly in trying to measure a company's social impact over the last few years. That's probably been the laggard of the three, albeit interestingly, and I might touch on it in a few moments, there has been and there is a change or an evolution, I suppose, in measurement techniques to address that challenge. But as I mentioned, social being perhaps a bit of a laggard, it is interesting that since COVID, it really has been the social aspect that has come under sharp focus. So, you know, the perception that S would take the backseat to E and G, I think, has gone out the window. And certainly, there's a consensus narrative, I think, that companies are under increased spotlight on social matters as they go through the pandemic. So how are they seen to respond to, with their employees? How are they engaged or being perceived to engage with customers and so forth? And there's examples of this, every week, right up to, the fashion retailer Woohoo last week, where again, coming under challenge and scrutiny for their management of supply chains and interaction with employees and suppliers. So the social piece has really come to the forefront through the pandemic, and again underscored, similar to E and G, that none of these are nice to haves for companies, but really must haves in terms of how they're seen to interact and engage with broader stakeholders. And I think, just on that point as well, in the last 3 months, 3 to 6 months, I think at this stage, through the pandemic, a lot of key stakeholders in the asset management and insurance industry have come out and reminded companies that, particularly going through a public health crisis, to ensure that ESG remains at the forefront of their priorities. And I thought just to, it would be, somewhat remiss to not maybe just pause on COVID for a moment, given, it's July 2020, and the fact that we're even doing this over a webinar. A number of you may have come into this session and had an open question as to whether COVID would, or has even, halted the somewhat inexorable rise of sustainable finance and ESG in the last year to two. But I think if you're asking that question, you're somewhat divorcing the interaction and even relationship, right, between human activity and the genesis of a lot of these crises, including the pandemic. So this slide here, which, and I'll maybe just tease that out, right? This slide here, which was released from the World Economic Forum in the start of this year, it's quite a useful chart, right? And if you look at where infectious disease resides, which is on the left, hopefully you can read it, on the left of the picture, and you contrast that to the likelihood and the impact of climate disaster on the far right, which would come from human activity. So COVID and all other pandemics in recent years, SARS, MERS, Ebola, can all be triggered or identified back to engendering in part from human activity. So with that context, and you look at where climate resides in this chart, and reflect on the experience we all have of going through the pandemic, I think the argument for acting for sustainable finance, becomes somewhat overwhelming, and it really does illuminate quite well the complex interplay between how we act in society and the potential adverse impacts that can arise. And more broadly, right, even just from if you to park the societal imperative that I'm perhaps talking about, from a pure asset allocation and performance perspective, in Q1 of 2020, so 2020, yes, 10 billion of capital flowed into ESG, which was more than half of all the capital flows that went into ESG in 2018. So, if I was to just briefly summarize, the pandemic has really illustrated, I think, that strong ESG credentials do positively impact company and society. And I think any suggestions that the pandemic will perhaps halt the ESG momentum are possibly misplaced. So very briefly, just to give you a flavor then of when we talk about ESG strategies, what do we mean? How do asset managers execute an ESG strategy? This slide really gives you a flavor or an indication of the core ESG strategies that exist. So strategies like exclusion, where you would exclude companies that drive a significant portion of their revenues from activities that are perceived to be negative for society, tobacco, gambling. Norms, so excluding companies that violate internationally recognized norms or conventions, for example, the Declaration of Human Rights. Best in class, probably the one of the more recent or new forms of strategies, so where you pick companies that have the highest ESG standards. Sustainability themes, you're picking companies that are active in sectors or themes related to sustainable development challenges. So, for example, water, renewables. And then voting, very common with a lot of our companies in our industry. So seen a lot more from the large asset managers using their influence to exercise voting rights on ESG. And then impact, so where here you invest to generate both social and governance impacts, as well as financial returns. And while I can appreciate that that's been a bit of a nebulous concept and has had a lot of challenges in the past, there is a growing tangible basis to measure impact, a lot of tools being developed. So again, coming a lot more accessible for companies to now measure their impact and capturing more than just financial returns. The next few slides, I won't labor in too much detail. They're really just to give you a flavor for how ESG has grown exponentially in the last few years, and how sustainable finance has really moved to the mainstream and a main focus area for mass asset managers and market participants. So this slide here just giving you a very succinct snapshot of that. Likewise, if I move on to the next slide. So again, here you're seeing the scale of assets under management, both in volume and number of signatories even that have signed up to the UNPRI in the last few years. And you see that sharp uptick in the last 2 years in particular. And again, the scale of assets under management that are now signed up to the UNPRI, which of course means they are making a commitment to move towards a more sustainable investment policy and investment practice. Here, this slide I think is probably the least sophisticated slide we have in our whole deck, and it is just to there's no science behind it. It's a very crude measure of just Google searches, and again, it was just put in to really just underscore the point of how ESG has become a much more search topic, a topic much more to the fore of people's minds, and that is just represented in a very simple way through a Google search, but just I thought useful nonetheless to give you a little bit of context again. Engagement and voting, so I mentioned that a few moments ago, just to give you a flavor as to some of the areas that managers are increasingly beginning to vote on, you know, whether it's climate risk or enhanced reporting over sustainability practices, and the linkage between strategy and sustainability. A lot of these areas are those that large asset managers in particular are using in exercising their influence around ESG. And then I think performance. So, you know, this is important, right? Because the growth in ESG isn't solely because there's been a moral compass shift in capital markets. You would hope that's a large part of it, but the reality is that the data does continue to show that companies or investments with high ESG scores are outperforming their peers. And we've seen this through the pandemic. We've seen it in the last 12 months in particular, that from a pure alpha or performance perspective, ESG funds have continued or have and continue to perform at least with their peers, if not in many respects, outperforming non-ESG benchmarks, indices, or pure stocks. In terms of how you'd integrate it into asset allocation, so again, I think just useful to give you this perspective, right, of conceptualizing it as a top-down approach. So, in an organization, how do companies or entities go about integrating ESG into their business? And I think this is a very useful slide at just showing that it really is a top-down approach, right? So it's identifying what matters to you, and you being your company and your stakeholders. Once you have that baseline understanding of what matters, you then need to crystallize that into a policy. So how are you going to design your standards or your KPIs for reporting? What are your objectives? And then once you've established that, it becomes a case of allocating the capital into the various assets that will allow you to achieve those objectives. And while this is a somewhat simple slide, it does actually really reflect how you do, if you interact with a company, or how we've interacted with companies, how and where you go about setting up a process and design and a framework to integrate ESG into the company. So while it may seem quite high level, it is in fact the core building blocks as to how, regardless of the level of sophistication, how you go about incorporating and integrating ESG into the asset allocation process. So very cognizant of the audience today, I want to just pause very briefly over maybe 2 or 3 slides before we go into the regulatory aspect on insurance specifically. So, I'll come on to the regulation in a minute, which is clearly consequential to the industry. But as you've hopefully gleaned over the last few slides, the focus on capital markets, capital markets even on sustainable finance, is growing profoundly, and the insurance industry is most certainly going to be at the forefront of this evolving landscape, which is in effect the points we've drawn out here, right? Just to give you a flavor as to why and where insurers are going to play a central role in identifying and managing material ESG risks. And I think particularly climate, and Shane is going to give you some helpful and useful context on that in a few moments. So as I've mentioned, ESG related themes are having an impact on more and more facets of our everyday life and the physical world or the environment. And as a result, ESG factors are becoming increasingly important in areas like the assessment of the risks into insurers' assets and their liabilities, to the future values of insurance firms' investment portfolios, and ultimately to the size of insurance claims that the firms are going to be subject to each year. And I think just for a moment to illustrate maybe how one of the ESG tenets are perhaps impacting insurers, and I will caveat, I'm not an insurance expert, so hopefully my example isn't too crude, but if you were to take environmental factors, they clearly have a major impact on an area like property and casualty insurance claims. So from one year to the next, if you think of over the long term, environmental factors naturally affect the health of the population, and therefore can have an impact on the cost of the health and sickness benefits, and ultimately you would expect the value and cost of annuity policies. And so if you reflect, I think it's reasonable to conclude that P&C claims arising from floods, fires, pollutions, etc., health insurance claims, mortality trends, all these could be materially impacted by ESG factors. And I think, again, it just underscores the real importance and the relevance of ESG to the insurance industry. And I think the only other comment I maybe want to give as it relates to insurance is there is a PSI guide, and a lot of you may be familiar with this, but it is aimed at insurance industry participants who want to develop their approach into integrating ESG risk considerations into their core insurance business processes and decision making. And it really is an excellent read. I obviously won't go into it now, but it is most certainly something I would recommend for those on the call to have a read and digest, particularly given its salience to the insurance industry. So last slide then before the regulatory piece. Hopefully what I've been able to capture and you've been able to appreciate is that there is no well, perhaps in the past maybe there was a trade-off or a perceived trade-off between financial returns and value-aligned investment choices. I think now with the evolution of ESG approaches, like even best in class that I mentioned a few moments ago, and the evolution of other ESG measurement practices that have expanded beyond maybe the more narrower strategies like exclusion, which was a very crude way that people went about ESG in the past. I think now that we have a much more sophisticated basis of ESG measurements, it means that an investment strategy anchored in ESG can not only match the returns, but also beat them. So you have very much a strong argument financially, and hopefully, as I've illustrated as well, a very strong argument from a sustainability perspective as well. And any suggestion that there's it's one or the other, profit or purpose, is most certainly misguided, and our view would be very much that it's a case of both. Okay, so moving on to the regulatory developments. I think very briefly, just again setting the scene somewhat on the regulatory piece. While market participants have acknowledged, as you've seen, that ESG is important over the last few slides, one of the challenges to date in this whole area has been the somewhat disparate and inconsistent data around ESG. So a lack of standardized or uniform basis to report and measure ESG metrics. And so to respond in a coherent way around all this, the EU, which is really at the vanguard and at the forefront of sustainable finance relative to any other jurisdictions in the world, it initially established a technical expert group to identify the key challenges and, more importantly, solutions that would allow them to achieve their overarching objectives on sustainable finance, being primarily to reorient capital flows into sustainable finance. That technical expert group identified a number of challenges, but more importantly, solutions as to how the EU would go about achieving their objectives on sustainable finance. those of which are demonstrated here on the slide. And that I suppose output of the technical expert group and their recommendations ultimately manifested in this really ambitious EU Sustainable Finance Plan. And I think the 5 key blocks are captured here. We're going to spend a few minutes just on 1 to 3 in particular, and that's not to perhaps trivialize the importance of number 4 and number 5, but the up until very, very recently, the guidance around what number 4 and 5 would mean was a lot less developed than 1 to 3, albeit in the very recent past, we now have some guidance on number 4, so the integration of sustainability risk. The EU has recently, the ESA, so the Joint Supervisory Authorities, have recently released draft regulatory technical standards that is going through a public consultation. And that gives us a flavor as to how and what the integration of ESG into risk management will look like. So perhaps something that people may want to go and read in their own time, but to just give you the headlines, it is very comprehensive. For those of you that have perhaps or may have seen the ESMA guidelines on this area that were out in 2019, they are very similar to those. But in a nutshell, they do push the envelope towards incorporating ESG into a mainstream risk. There's prescriptive guidance on what you would need to incorporate into due diligence. And there is also more guidance around what's expected in terms of the level of competence, experience, knowledge that to have of sustainability and incorporate it into the mainstream risk management of an organization. And likewise with number 5, we have some guidance now as well in form of draft RTA regulatory standards as to what's expected for the type and nature of advice and interaction with clients up front on sustainability. So as I said, these are going through a consultation at the moment. I don't have detailed slides on them. I've given you perhaps the succinct points to take away, and they will or are envisaged to come in through draft or amended delegated acts over the next 18 months. But if I maybe talk on one start with the disclosures regulation. So there's the two main pieces I think are the disclosure regulation, the taxonomy regulation. And I appreciate these slides are very text heavy. I do apologize, and I know these slides will be sent afterwards, so you can most certainly read them again, but they are text heavy, you know, really as a derivative of how dense and extensive this regulation will be. So if I just, I won't read the slides verbatim and just give you the headlines over the next few minutes. On the disclosures regulation, key point here is this applies to everyone, right? And all financial, when I say everyone, I mean all financial market participants within the EU. So regardless as to whether you are endeavoring in ESG or not, there is a baseline set of disclosure requirements that will hit everyone. There is then an elevated set of requirements for disclosures if you do have an ESG specific fund or an ESG specific product that you will need to give detail on. In terms of the where and what type of disclosures, so the where, these disclosures primarily will go in either upfront contractual documents, you know, things like the prospectus, or your website. So there isn't a, certainly as yet, an impact for financial statements. They are very much going up on the website or the prospectus. In terms of the what, you are giving more disclosures on sustainability risk policies. You're giving much more disclosures on how they were incorporated into due diligence policies and how they were considered in making investment decisions on sustainability factors, and giving much more disclosures on the lineage between remuneration policies and how they are or are not consistent with sustainability risks. And then of course, you're giving much more disclosures on sustainability risks and sustainable investments as well. The next slide is just to give you a sense of the elevated disclosure requirements for an ESG specific fund. So again, I won't go into all the detail, but key points are there's clearly a lot more disclosures that you need to give, primarily on the actual products and the fund itself and the nature of the ESG products, the nature of the risks, the factors you considered in measuring the ESG, the screening criteria, and all the stuff that you might expect. So the taxonomy regulations, so all the facets of the EU Sustainable Finance Plan, this is arguably the most important, right? And the reason I say that it is, I'm sure many of you have heard the term greenwashing, where, you know, one of the core challenges now is that funds, entities, companies can badge investment products or funds as sustainable, as green, as ESG, without any real veracity behind that, or any challenge to it. Now we are moving to a position through the taxonomy where a prescriptive set of criteria and regulation will come in that need to be addressed and need to be adhered to allow a fund, an entity, company badge or label a product as sustainable or otherwise. And without meeting this criteria, you cannot do that. So it obviates the ability to greenwash or badge something as sustainable or otherwise on a go-forward basis. The taxonomy regulation has 6 key pillars to it, so 6 areas where there will be measurement criteria under each. So climate change mitigation, climate change adaptation, transition to a circular economy, pollution prevention, protection of biodiversity, and sustainable use of water. They being the 6 key pillars. You must contribute substantially to at least one of them and not significantly harm any of the others. So the criteria to contribute substantially and the criteria to not significantly harm, that is not going to be open to interpretation. There's going to be prescriptive regulation and screening criteria under each of those 6 headings that an entity will need to adhere to, comply with, report on, and disclose. So hopefully what you're appreciating here is that it is very significant. It is going to be very onerous. To give you a bit of a flavor, we have a draft guide currently in the public domain as to what the nature of the criteria for climate change mitigation and climate change adaptation will be. And again, very extensive, very granular, very prescriptive, and that is just 2 of the 6. So the taxonomy regulation will come in on a staggered basis. The first 2, arguably the most significant 2, climate change mitigation and climate change adaptation, will come in from 1 January 2022, and the other 4 will come in from 1 January 2023 through delegated acts. And then here is just a very brief context as to there's more disclosures again for sustainable investment. So if you do satisfy the taxonomy regulation and you have a ESG product or a sustainable product, there is another suite of disclosures you will need to give in addition to the baseline disclosures I referred to a few moments ago. And here, when I say my comments that all financial market participants are caught by the disclosures regulation, so this is who I mean. And again, you'll see that there's insurance, asset management, retail banking, all various, excuse me, participants that are caught. So I think a very useful slide just to reflect on, and gives you a sense of the scale of people and entities that are hit. Just a very brief digression from the core sustainable finance plan. But a relevant one. One of the challenges is that clearly, if a fund, a product, an entity is giving disclosures at their level, they are reliant on the quality and consistency of sustainable disclosures at an investee level, so the underlying companies. So for those companies which are generally our EU PIs, greater than 500 employees, which of course a lot of large insurance companies will be, there is also currently an amendment to the non-financial reporting directive, which is going to result in a lot of elevated disclosures for those entities. So in tandem with the sustainable finance plan, we have significant developments in sustainable finance reporting for the large EU entities that will come into effect from June of 2021. So it's just to be aware of it because it is very much relevant as well. So the last few slides, just conscious of my time slot, that I will really just whistle through, and it's just so that you're aware of them. There's changes, as I mentioned, in the 5 pillars to benchmarks regulation as well. So in effect, we have 1 new category comprising 2 new benchmarks, a low carbon benchmark where stocks are selected on reduced emissions, and then a much more ambitious benchmark where stocks are selected on them being carbon positive. And in addition, since April of this year, all benchmarks in the EU, with the exception of interest and currency benchmarks, now have to disclose how ESG factors are reflected in the benchmark. and the next few slides are really just for you to take away, and they're summary and knowledge sharing more so as to the type of legislation that's going to change, the type of legislation that's impacted all through the Sustainable Finance Plan. And again, hopefully it's illustrating quite well that the changes are going to be quite significant and extensive in their reach. Here is just it touches quite well on how this remains fluid. Okay, so I will come to a slide in a second that shows the timelines. There's a lot of moving parts. We don't yet have clarity on all the legislation. We don't yet have clarity on how all the regulation will fall into place and what it will look like. So it is very much an iterative legislation that's being constantly developed and released. Every week we have something new that comes out, and this is just to touch on some of the latest regulatory developments we've had in the past couple of weeks, and then primarily being what I referred to earlier around some of the draft criteria that's now in the public domain from the joint European supervisory authorities, to give you a sense and a flavour for what is coming down the line. And I think it is somewhat unhelpful and somewhat challenging that a lot of this won't come to fruition or finalization until a very short period before actual requirement for implementation. So, for example, the disclosures regulation, which comes into effect from March of 2021, the final guidance and requirements around the disclosure regulation won't be set until December 2020. So a very short gap for companies to prepare, really, between when the final legislation falls into place and when it's required to be implemented in law. Here, just give you a flavour for other terms you might hear of. A lot of these will become moot in the next 24 months as the EU moves to a standardised, streamlined framework. But I think for now, important that you're aware of them nonetheless. TCFD probably being the most significant for climate, and GRI for broader ESG type disclosures. So I think this slide is useful just for you to understand how it impacts both EU, non-EU managers and products and services. So it is the regulation is going to hit everyone, including non-EU managers, and obviously there's a relevance here with Brexit coming down the line as well. But the headline, I suppose, is that everyone is caught to some extent or another. And then lastly, just to give you a sense of the timelines, so between now and 2023, quite significant, starting really from March of next year when we have the disclosures regulation, and then from the start of 2022, we have the taxonomy regulation, which comes in between January 22 and January 2023. So look, these slides will be sent afterwards, and you can read them in your own time. I appreciate you can't digest everything on the screen right now, but hopefully it gives you a very useful and succinct snapshot as to what's coming and when it's coming. So Shane, I might hand over to you if that's okay.
Thanks very much, Conor. So you can drive the slides if that's all right. Perfect. So hello everyone, Shane O'Reilly here. I'm part of the Sustainable Futures team within KPMG, and what I'm going to briefly touch on today are some of the climate-related risks, particularly attributed to or applicable to the insurance sector. So what I'm going to really start with in this slide is set the scene and give you an overview of an understanding that climate change has moved from the realm of academia and purely difficult science. It has moved into media. It has moved into public consciousness. I'm sure a lot of people on the call here were dragged out with their kids to climate protests in Dublin last year, and we're all very, very familiar with the level of awareness that Greta Thunberg has brought on the world scene. Climate change and climate risk is not a single topic. It's very, very broad, very diverse, and you'll hear me say that over the next number of slides. And I'll just draw your attention. Conor brought it up earlier, showing where COVID and infectious diseases were relative to the World Economic Forum and their global risk report. And I'm just taking it a slightly different view and adding to it in a snapshot in time. So on the right-hand side, you can see in 2010, the World Economic Forum splits the issues over likelihood and impact across economic, environment, social, geopolitical, and technical. And the color code there of blue stands out very clearly in 2010. 2010 economic issues were to the fore, and we fast forward 10 years, and the top 5 in terms of likelihood of risk to occur are all green, all environmental, and closely related, but actually specific issues in themselves. And then in terms of impact, 3 of the 5 are green as well in terms of environment, but one could argue that the societal issue of water crisis and water shortage and water stressed areas and the risk of flooding also forms an environmental criteria. So the best part of 9 of the 10 indicators split between risk and likelihood are all climate related. So that's a snapshot of where what I mean by the broad range and nature, how it impacts across the economy, how it impacts across all sectors and all geographies. It's not only for corporates, but there's also a clear impact for insurers, be it on the underwriting side or from an investor perspective. I might ask you to drive on the next one, Connor, please. So what do we actually mean by climate-related risks? In broad terms, there are two criteria around physical and transition. Physical risks are further split into 2 areas: acute, being somewhat short-term in nature, extreme weather events like hurricanes and floods, and chronic tends to refer to longer time horizon events like rising sea levels, rising mean global temperatures, etc. And then in terms of day-to-day risk, as I'm terming them, really are the transition risks. So in the short to medium term, what risks are insurers, the insurance sector, and corporates in general exposed to? And they fall into 4 main areas of policy and legal, technological, markets, and reputation. So on the policy and legal, in terms of in an EU context, is probably the main driver of this, and the Green Deal, EU taxonomy that Connor spoke extensively about. These are all driving parts to the policy side of it, and regulations around carbon, around emissions, exposure to those in terms of litigation are all on the increase. Technology is probably very prevalent in a lot of people's minds in the substitution of existing products for ones that are lower risk in terms of climate impact, consumerism, and voting with their feet in terms of products change and substitution is very prevalent in the marketplace. And then reputation, of course, plays a key part in terms of climate. We only have to look to Volkswagen and the impact it had on share price, the impact it had on executives in jail time, etc., etc. So that's the kind of nature of what those climate-related risks are. And really and truly, the transition to a lower carbon economy will have a profound impact on all aspects of society. I mean, physical risks are further amplified by the increased nature of urbanization. We are on a trajectory of population growth of approximately 10 billion people by 2050. And that's going to really exaggerate the impact on transition and how we get to a lower carbon economy. In terms of timescale, particularly with transition, climate-related risk, we are probably looking at a very short-term timescale of 2020 to 2030, in which we have to make a significant effort to turn the tide. So Connor, you might flick on to the next one, please, if that's okay. So where are we? The science, a lot of you are familiar with the broad term of it in terms of a 2-degree temperature at horizon to the end of the century. That's been revised by the IPCC of late to 1.5 pathway that we must be on. At the minute, we are on a trajectory of approximately 3 to 6 degree temperature horizon against pre-industrial levels. So we're not quite anywhere near where we should be. It's still time to change it around, and that's my point in relation to 2030 being key as part of that transition period. And just in an Irish context, the part that we're trying to play, the recent programme for government had, as part of the ambition that Ireland would have a 7% reduction in CO2 emissions every year over the next decade. And just to give you some flavour of context of what that actually might mean, if you look at the chart on the bottom left, which shows below the zero line global issues over time, and I've just picked out two in particular. So this chart is showing the impact of CO2 at different points in time, and in 2008-9, you can see the first arrow pointing at how CO2 reduction played out over that period of time. Now, if we look to 2020 on its own, this is the H1 number that we are, after taking approximately 3 gigatons of CO2 out of the system, just as an indication of the impact from COVID-19. That 3 gigatons is about 8% per annum. So our ambition at a national level to reduce CO2 is quite profound and very, very ambitious. Flip to the next slide, Conor, please. So where do these impacts from climate risk play out for the insurance sector? Where do they play out for corporates? The model on the right-hand side is from the TCFD risks and opportunities publications, and you can see the physical and transition risks in red I spoke of earlier. They percolate through into strategic management and risk management of companies, and then of course that they're going to peter down into cash flow, into income and ultimately balance sheets. But it's not it's not all doom and gloom. It's very, very important to also focus on the potential opportunities that are out there. In many instances, the risks that we identified within a risk register, the corollary of them are opportunities, particularly transition risks. There's quite a lot of potential risk around substitute products, but the flip of them means that a lot of products get accelerated, being brought to market. For example, electric vehicles is not a bad example there. But in terms of insurance companies, the risk is, in transition terms, really around physical damage to assets, from flooding, from risk of supply chain, because further up the chain or further down the chain have been dramatically impacted by adverse weather conditions, production operation disruptions, and so on and so forth. Conor, we might flick on to the next one, please. So the role of insurers is really, really quite important when it comes to climate change, particularly in assessing and managing climate risks. Plenty of expertise, long-standing understanding, long-standing modelling and scenario analysis. But perhaps there's a new trick in town in that 1 in 100-year events that were possibly happening 50, 60 years ago are now 1 in 50 events. And accelerating to potentially 1 in 10 events. And in terms of the impact at an investor level with 30 trillion of assets and counting, the impact is very, very clear. It's also a potential for risk mispricing coming into play, where if we take recent examples in the United States, large swathes of counties, communities and neighborhoods that didn't have flood insurance because they weren't required to, because it was a very low risk area, particularly in Texas, found themselves in a bad way. And the trickle effect for the insurance sector is all very, very clear. No insurance impacts directly the ability to repay loans, which impacts directly on the quality of portfolios for banks and insurers. So it's very clear the interconnected nature, not just of climate-related risks from an environmental perspective, but how they actually play in the financial sector also. Conor, you might drive on to the next one. So what tools are available? Conor mentioned earlier the PSI guidelines, really top-notch stuff there for the sector. Really delving into the various risks and exposures across different sectors. Highly recommend, if you haven't done so already, to dip into that. From a corporate's perspective, and what you can do from the insurance sector to help corporates is help them understand their reporting requirements, help them understand what standards they should be looking to. TCFD, Conor mentioned, is a prevalent one in the EU context, which is a voluntary disclosure initiative at the minute, but it's linked more and more now with regulatory policy, and potentially could be a mandatory exercise in the future. So getting to grips with that earlier and putting companies on a particular trajectory is very, very important. From an internal perspective, we have several tools that we can point to. Most prevalent in terms of this conversation is the dynamic risk assessment. If you flick onto the next one, Conor, that might be useful to give some color on that. The next couple of slides are detail on dynamic risk assessment, and I'll leave them with you to go through in your own time afterwards. But in a broad sense, it's taking a traditional, almost two-dimensional risk map and developing that further to show the interconnected nature of the risks, and considers contagion effects of individual risks, and more importantly then there's a vector component, how fast, what speed at which these risks can affect an organization. Identifies systematic risk and most significant risk, and helps inform clients in a forward-looking strategic direction. And then that sits very, very well again with some of the non-financial reporting frameworks out there at the moment, who are not really relying on historic information, but they're trying to model what the impact in a future sense would be for climate, for corporates, for portfolio managers, asset owners, etc. So it sits all very well with a forward-looking, interconnected view. And the next slide, Conor. And there's some case studies and links that in your own time post the webinar you can flick onto and get a lot more detail on the DRA tool and how it impacts and works well with ESG and ESG lens. So that's it from me. The next slide is again another case study that you can delve into in the city of Sydney. By all means, take time to go through it. It's a great looking slide. It's a headache of a thing to untangle, but actually really interesting. So thank you for your time, and happy to take any questions if there are any in the portal.
Thanks, Shane. Conor here again. There is actually one question in, Shane, that's probably best for you. So what, in your perspective, would be the level of expectation for corporates when it comes to readiness for climate change?
Okay, good question. I think from an institutional investor perspective, particularly from the insurance side of things, I think they're looking for corporates to display a level of ambition. No one has all the answers right now. The slide I had mentioned earlier in relation to sorry, lost my train of thought there for a second. Yeah, so their level of ambition and what they're actually capable of doing into the future is very, very important. Historic metrics and targets, and achieving those targets makes you a credible organization, and that helps you stem the tide, if you like. The transition that I spoke of 2020 to 2030 is a very, very important time. It's a very uncertain time. And if you've got a credible history of delivering on sustainability metrics, you're not at the top of the list of activism. You're probably not at the top of the list in terms of negative voting against resolutions at AGMs, etc. So developing a sustainability narrative and strategy and being able to communicate that effectively to institutional investors and wider stakeholders would be key.
Great. Okay. Thanks, Shane. One question that's come in that I think I can take. So disclosures regulation also requires to insurers producing insurance-based investment products. The answer is yes. Again, the regulation does specify the nature of the products that are in play, but insurance-based investment products are relevant. I would highlight that there is a difference, well, two differences to maybe highlight. One, there is a difference between, and actually we have another question that I think I'll address by this question or this answer too. There is a difference between entity disclosures and product disclosures. So both are caught, but they are not necessarily the same disclosures. So as you can appreciate, there is a different and perhaps more granular set of disclosure requirements at the product level, particularly that's where you'll have to demonstrate that the product is sustainable or otherwise, or if you're considering the adverse impact as to why it doesn't have any adverse impacts on the core taxonomy pieces. You have a quite prescriptive set even of disclosure requirements at that product level. So yes is the answer to that direct question, but then also the question around, is there a difference between the entity level disclosures and the product level disclosures? Yes, there is. I won't go into all of them now, but as I said, it's probably a bit more prescriptive at the product level than the entity level. And the ESAs, as I referred to earlier, have now issued the draft regulatory technical standards. So like a pure Google search can get you them, but I'm of course very happy to share with the person who's asked the question, those or anyone else through Insurance Ireland, the draft standards that we have out that now do provide the, I suppose, level of granularity that's required and that will be expected in terms of some of these disclosures. And I really can't, beg your pardon, I really can't emphasize enough just how granular and onerous they are. It certainly took certain areas of the industry by surprise, given the level of detail that is to be expected. Some of these even require calculations. So I would encourage everyone on the call, to the extent they are not familiar with what's out there in the ether on disclosures at the moment, to familiarize yourself with the level of detail that's out there, because the change and the, I suppose, need to get prepared is most certainly relevant now. There's one other question relates to Brexit, around whether post-Brexit does not onshore evolving EU legislation. Yeah, so the question is in essence around impact from Brexit and how the one set of legislation in the EU, obviously ourselves in Ireland, vis-a-vis what's in the UK. So it's actually a really good question. Interestingly, there's been a lot of noise in the UK very recently, actually, and some of you may be familiar with it. So a number of large asset managers and insurers wrote to the FCA to, in effect, get their act together quickly. So the EU, as you've hopefully now taken from the last hour, has very much put a coherent and structured methodology and framework around sustainable finance reporting, and the UK has not followed suit yet. So I probably answered in two parts. Yes, there is likely to be a divergence, albeit the UK has indicated that they will map very closely with the EU. But I would couch that in that, to the extent that there's any marketing or any real interaction with the EU, even if there's a non-UK parent, then you will be caught by the disclosures piece. So even in the context of a wrapper, if the parent is in the UK but you have an Irish entity, or you are marketing in Ireland or the EU area, you will be caught by the legislation. Okay, I might just check maybe one more question that's come in. Shane, you might want to take it. So has the COVID crisis meant that ESG or the climate related focus has slipped down the strategic priority list?
I think what's happened is, in short, it probably has in many ways, in terms of capital spend or projects that were aimed at replacing kit and equipment for reducing CO2. But what has come into sharper focus as a result of COVID, I think you touched off it earlier, is in relation to the social side of climate-related risk. And what I mean by that is, in particular detail, our supply chain risk. So an evaluation of companies, how were they impacted by their supply chain during COVID, which happened in a very, very accelerated way, was a potential snapshot of the transition risk around supply chain that I spoke of. So companies that might have had quite narrow supply chains were probably hardest hit. Companies that had very shallow but broad supply chains probably had huge chunks of the supply chain eroded, but potentially had a fleet of foot then to adapt and keep materials in, or indeed they found themselves on the flip of it and were impacted and not being able to get their product in a timely fashion to their customers or client. So in a capital sense, probably climate has been impacted in pausing pulling the trigger on capital spend, but certainly supply chain and social issues have been accelerated.
Yeah. Okay. Maybe one last question before we go, I think, is on, is there any exemption on the disclosures relative to size? And it's a really good question, because interestingly, no distinction has been made yet anyway, with regard to size. So there is one aspect. If you an investment manager with more than 500 employees, you do have an elevated set of disclosure requirements, but there's not the aspect where you might hope that there's a much reduced set of disclosure requirements for smaller entities. So all those baseline disclosures I referred to earlier, they are caught by everyone. The only change is there's more perhaps if you were a much bigger entity, but there's not less if you're a smaller entity. So it's an excellent question, because there's a lot of noise in the system around that. And as I mentioned, aspects of the regulation remain fluid and are not yet fully finalized. So it may be something that is sharpened as we get closer to actual finalization of the regulation in December this year. But as it stands, no, there's, other than more for the larger entities, that there isn't a difference. Okay, I think our time is pretty much up, and I suppose on behalf of Shane and myself, again, thanks to Insurance Ireland for allowing us present to you this afternoon, and thank you everyone for joining. Hopefully you found it useful and informative. We'll send the slides subsequently for you to read and digest. Our contact details are here, particularly if you want to follow any of us on the KPMG team on LinkedIn as we share the various material as it comes out. And if anyone has any questions or need to follow up in the meantime, we're more than happy to engage in the next while. In the meantime, thanks very much everyone, and enjoy the rest of your day.
Thanks very much. Bye now.